Yet our next guest says the big lenders are mostly healthy. That's Brad Hintz. He's a banking analyst at Sanford Bernstein, also former CFO at Lehman Brothers. Welcome to In Business.
Thank you.
So is mostly healthy a reason to buy?
Well, you know, they're trading at such a low level, so this from a value point of view,
right.
The issue that you have is if someone's trading at 0.8 times tangible book, will they go back to tangible book? And I think we can look at this and say what we have is a very intrusive Federal Reserve, you know, certainly being very conservative on the banks. And the banks have relatively clean balance sheets at this point. So at some point, you know, they trade back to largely their liquidation value, which is tangible book. The issue here is, you know, will the banks' ROEs be as high as what they've been in the past? The answer is no. So will banks ever be a growth stock? Probably not. But are they a potential for value? Absolutely.
We said this could be a best case scenario because what you were just talking about there, the Federal Reserve pushing towards that 3% versus what had been rumored to maybe even be as high as a 7% increase. I mean, is this the best case that you could hope for?
Well, anything that you can do to take the uncertainty away. I mean, if you're
any clarity,
well,
period.
Exactly. If you're an institutional investor right now, you don't know about litigation risk.
Right.
You don't know about the regulatory capital. The companies themselves are retaining the capital because they're uncertain. And then you're not certain that there's enough discipline inside the companies to adjust their cost structures to what will be higher capital charges. Now, things never turn out as bad as one thinks that they could be. So, you know, let's face it. The financial institutions, they can't be both greedy and foolish in the sense of not changing their margins. So my guess is what we'll see here is over a period of time, as the rules roll out, a democratization of Basel III. You're going to charge.
What do you mean by that?
Well, you're going to pay more in terms of rates if you take out a loan.
They're going to share the cost.
Well, exactly.
I don't know if that's the kind of democracy most people want when they talk about democratization of finance. But when we look at the financial space right now, I would say, even on top of all the regulatory risk you talked about, look at what we just saw with the housing market, with housing prices still on the decline, with sales themselves still declining. Doesn't that bring you back to the point where you begin to worry more about the Bank of America's, more about those retail banks with exposure there?
Well, you see, now you're talking about a sector, and you know, if you have housing risk, you know, you're at a point where you're not getting the improvement that the market had hoped. If we have a double dip in the economy, you know, now we're not forecasting that we're going to have a double dip in the economy. Now we have another credit event which will hurt the banks. But at this point, you know, if the economy works its way through without that double dip, if this is just simply a slowdown, you know, commercial banks will adjust to the new capital charges. Their ROEs won't be as high. They'll cut their compensation. You're already seeing this on the trading side, that they're automating trading in fixed income, which means, you know, why are they doing that? They're not doing this out of the goodness of their heart. They're doing this because leverage ratios are lower. Their ability to take risk has been constrained. What do? You cut your expenses. So, you know, I think one of the mistakes that analysts make, and in many cases investors are too, is they assume that these companies aren't going to make any changes. And of course, they're all making changes.
Changes in terms of?
How will they survive in this brave new world of greater capital? That's the reason why you're hearing some of the more outspoken management teams saying, give us the rules. We'll adjust once you give us the rules. And it's really the uncertainty that's leading to you know, where no one wants to talk about banks.
Is that also why you could say there's no velocity of money right now, that the lending, the profits aren't coming from actual lending, actual business?
Well, now that's a different issue. That's the curious issue of we have examiners out in the marketplace, right? I mean, so we think of bank examiners. You know, what have they've just gone through the crisis event of their entire career. Therefore, they don't want to make a mistake. So the Federal Reserve and the administration telling you, the bank, lend, right? Management saying lend. Yet down at the coverage officer, the credit officer, the calling officer, plus the examiner, they're all a little bit reluctant to lend. And so, unfortunately, you can't push on a string. So, the economy's not booming. The orders from the top say to lend, but there's a natural conservatism. And you're even seeing that in the retail side, which is the retail investor is not embracing risk yet at this point. Well, the same thing is true with anyone who has been scared. It'll take a while for the fear to kind of disappear into the past for these guys. But will lending be a good business? Yeah, I think lending will be a fine business, but that's because we will have established an oligopoly of banks, right?
Yeah.
I mean, there aren't as many banks as there used to be. And if you want to do a shared credit, a giant loan, you're only going to go to 4 or 5 banks in the United States, and they will charge for that.
So it's bottom line is, you say there are healthy banks out there, but you got to be even more stock specific. It sounds like you can't even look at this as a sector. We just went through all the reasons why every example is different here.
Exactly.
It's getting choosier and choosier. Thank you so much, Brad, for running us through your thought and your reaction.